And if you put those reasons together, the fall in essential item inflation, growing wages, high levels of discretionary spending power that still exists in the economy, high levels of interest coverage, or insensitive to interest rates, basically because of high coverage ratios in the household and the corporate sector, then you begin to form a picture of why rates have had no effect, and why people still expect 1% real GDP growth in the US, or we're only now more recently talking about recessionary type characteristics in Germany. And so therefore it's quite difficult. And I think the central banks actually have more work to do on the upside, not on the downside.
Welcome to the next big trade, and thanks for joining us. This week I'm talking to Seamus Murphy, founder of Carraighill, an independent research boutique focused on the financial sector in Europe, UK, and select emerging markets, including Brazil and Mexico, some of my favorite emerging markets as it happens. Seamus, how are you doing?
I'm excellent, even though the weather isn't great in Dublin right now. So,
I wouldn't worry, mate. I'm in Boston. It's been pissing down the whole summer. It's astonishing. It's like a tropical rainforest.
Yes.
So, Seamus, can you improve on my crap introduction? Can you tell us more about Carraighill?
Well, I suppose I've been working with financials for nearly 25 years, and I suppose I was lucky enough to have worked through the 2000 Nasdaq bubble, the GFC, and I suppose after the GFC, it became very obvious that we were a research firm. I worked for a research firm, and but they were very focused basically on just a lot of the micro about the companies, missed basically the bigger picture, as we would call it, in terms of the factors that kind of influence the environment in which companies operate. So that's what we try to do here, is just have an exceptionally deep understanding of the data and what influences the environment in which financials operate. So obviously for financials, for example, interest rates are obviously a key component. The expected evolution of, cost of credit, cost of risk, all these kind of factors. And then obviously within individuals, we kind of mirror that with the individual companies, where we speak with the companies and they either verify or refute our thoughts. But I suppose a lot of firms as well focus a lot on the very short-term data. We try to be quite long-term in our thought process, to take it back through cycles, which helps us try to understand. But then more recently, we've obviously been doing the shorter-term data. It's kind of a bit of a unique approach in the context of how we think about financials.
Yeah, I read you were kind enough to send me a lot of material to take a look at, and I found it fascinating. I think this is going to be quite a stimulating discussion. Probably let's why waste time with me blowing on. Let's go into your next big trade. What should people be focused on?
Well, I suppose the big thing for us, there's two big things. One is we've obviously had a period of exceptionally low interest rates for let's call it a decade in Europe and globally. And during that period, we've had, a kind of dysfunction, I suppose, come into play across the financial markets, especially within the individual sectors within financials. So, a couple of things are important for us. We think we're entering a period of higher rates for longer. We don't think we're finished. The cycle is over yet. There's a couple of key reasons for that. And then, so European banks for us still look exceptionally interesting. They have been, a terrible trade, inverted commas, or a terrible investment for well over a decade. But European banks, in our opinion, are still very interesting. I think the narrative has changed in Europe. The political narrative has changed in Europe. The economic narrative has changed in Europe. And also the consequence, the byproduct of that, is that we're now entering, we think, an exceptionally difficult period for private equity, asset management, and a more difficult period for household savings. But all these things take time to play out. I suppose if you don't mind, Harry, like, even if we think about what's happening today, obviously everybody has been trying to call peak interest rates in Europe and in the US for quite a while. Our view for kind of 6 to 9 months is that, like, even if money supply is falling, it's actually, you're kind of missing the picture to some extent, because the productivity of debt has been picking up for, sequentially quarter on quarter for the last 5 to 6 quarters, and therefore the velocity of money has actually been picking up. And so therefore, when you look at real GDP expectations, we're still not in recession territory, anywhere near it. And so therefore, I think the question is, we have to kind of ask ourselves when we think about financials in the broader sense in Europe and the UK and in these emerging markets is, why monetary policy has been completely ineffective to date. Because I think if we sat here, Harry, this time last year, and I think anybody would have said, and we expected US rates to be where they are, European rates to be at 4, and no issues, UK rates to be, people talking peak rates in the UK now 6. I think most people would have said, equity markets would have been at substantially lower, and we would be have a very difficult backdrop for banks. Cost of risk for banks would be through the roof, and I suppose it's important to understand why that hasn't happened so far.
Totally agree. For me, it's the question. I've got a working hypothesis, but I'm very curious about your thinking on this.
Yeah.
So what is the mechanism?
And I suppose, look, for us, in terms of how we think about the data, I don't know if Gabrielle can put up the data just in terms of the household net worth growth between 19 and 21. There's kind of 5 key reasons, basically, in terms of why we haven't had, monetary policy has been relatively ineffective to date, let's call it that. The first one was we had excessive wealth creation during the pandemic. If you look at the US, normally in the US, you get kind of, wealth grows at nominal GDP plus a little, which is, 7 to 8%. But during between the period 19 to 21, we had over 100% growth in as a share of GDP, basically, 107% growth in over 2 years, which is really excessive. We had, obviously Europe is slightly lower because we just have less financial wealth, but nonetheless, we still had excessive wealth creation in these countries. The other thing that happened, obviously, then when we move forward is that we just had an exceptionally strong period of household cash flow generation. Gross savings rose really, really substantially. But I suppose this is due to the fiscal intervention of the governments. But also, it wasn't only related to the fact that the governments intervened on the fiscal side in terms of supporting jobs and paying people actual money, but they also intervened in guaranteeing loans. And I think that's really important because therefore we had a very fluid system where everything was guaranteed. I mean, we were speaking with a local Italian bank recently, and we think they were telling us something like 30% of their loan book is still guaranteed by the state on the corporate side, which is pretty astonishing. And so therefore we still have that adjustment back to normality to come, or is still ongoing, basically, in these regions. And I suppose what a lot of people are saying when we read the typical narrative is that, this adjustment has already happened. This has already happened. But what's actually equally as important, Harry, is that what makes it more complicated now is that the adjustment that has happened isn't actually as simple as one thinks, because what we try to do here is we dissect basically consumption into what we call essential and discretionary items. And one of the characteristics of this cycle, and the third reason why it's different this cycle, is that what we call discretionary spending power is actually going up sequentially month on month in most regions. And why is that happening? I mean, you have exceptionally strong wage growth in most regions, but then you have essential item inflation now negative. So therefore, if you have wage growth, and for example, we look at Belgium, where you have, if Gabrielle could put up the chart on Belgium employee compensation, you'll see Belgium compensation growing at 9 and 5 in 23 and 24. But on the following graph, you'll see that, essential item inflation, basically in some regions, for example, we pick out Spain, but it's happening everywhere, is falling. And so therefore, when you look at Germany, if you look at household discretionary spending power, which is an earlier graph, you'll see that that's actually sequentially rising time on time. And what does that actually mean? What that means basically is that if discretionary spending or spending power is growing, it means that people have more money to spend, not less money to spend. And so therefore, the central banks have to eliminate that excess demand, or have to fight harder to eliminate that excess demand. So if Gabrielle can put up the chart of Germany, for example, which is of discretionary spending power in Germany, household discretionary spending power, you'll see that that is sequentially still rising year on year. The most recent data point, for example, to May, shows that discretionary spending power in real terms up 15% in Belgium, 5% in the Netherlands, 8% in Ireland, Germany at 7%. I mean, these are astonishing numbers, and so therefore the demand still exists in the economy, and central banks are now going to have to fight even harder to eliminate that demand. So that's kind of sorry, Harry, go ahead.
I was just going to say that's driven. Is it entirely real wages driving that increase in disposable incomes, or are there other factors as well?
Well, I suppose you get the wage growth basically in terms of, let's deal in nominal terms to start. You have wages obviously growing in nominal terms.
Yeah.
And if we think about what is an essential item basically, so what we do, it's not like we ignore core CPI. And what we did is we basically took there's a data set in that's common across all the euro area and the UK. We took the 120 items in that data set and basically put it into essential or non-essential items. Essential items obviously your food, travel, travel to work, all these kind of things. I mean, like for example, a service of your car an essential item, but the purchase of a car is a discretionary item. And we can match that to the CPI month on month. And what it showed us basically is that, so last year when we were looking at the numbers there in the middle of last year, we were expecting basically the fact that because essential items are rising so quickly, we were expecting discretionary spending to fall. And there's a lot of payment companies in Europe, a lot of discretionary companies in Europe, a lot of clothing companies in Europe where we expected profit warnings from some of these firms, but it just wasn't happening. And so what the companies were telling us was that things were exceptionally good. All the banks telling us there's no issues on cost of risk, and we were saying, oh my God, what really is going on here? And then when we dug into the data, we started developing this household discretionary spending power index. And when we looked at it across all of Europe, it became very obvious that nominal wages are growing quite quickly, and essential item inflation was growing, but not as quickly as wages. And so therefore discretionary spending power was actually increasing. And what's happening now is the ECB has raised into this, the Bank of England has raised into this, but what the most complicated thing for these guys now is the fact that you still have this wage growth expectations, which is a lag effect because it's an averaging effect, into an environment where essential items are now negative in some European countries, are falling really, really aggressively. And so therefore you do have this excess demand that still persists. But the problem with excess demand, it's not a supply side issue anymore in one sense in terms of the rate curve, because supply chain indexes, all the indices are basically telling us that we're back close to normality. It really is just a demand issue. And so we do have to equalize this demand. The other thing, Harry, just moving off that for a second, is the other really important thing to understand is that we also entered into 2023 in a very different period or very different kind of era relative to prior cycle.
Hey, sorry to interrupt again. It's Raoul here from Real Vision. I'd love for you to subscribe to the channel, get the notifications. We have so many incredible conversations with so many amazing people. It will really help you in your financial journey and your journey to understand just what the hell's going on in this world. Anyway, click subscribe, get the notifications, and enjoy.
So if Gabrielle wouldn't mind just putting up the chart of the coverage ratio on, let's suppose, corporate coverage ratios in Germany, and what's basically, I suppose what it is we become increasingly insensitive in some senses, Harry, to interest paid. And so if you think back, this is a chart going back for 20 years. This is just Germany, but this is similar across most of Europe, whereby if you think about coming into the last recession, basically back in 2008, the German interest coverage ratio, corporate interest coverage ratio, was running kind of 8 to 9. It fell, 10, 15, 20% percentage, points, or 2 to 3 percentage points during the GFC. But since the GFC, since we've had exceptionally loose policy, interest paid by the corporate sector in Germany has fallen, significantly. Profits have increased rapidly, or EBITDA has increased rapidly to such an extent, especially, and you'll see the move, and especially, I suppose, the last move, the big move happened, liquidity surged, rates fell, and so in Q1 2022, we had a coverage ratio of interest of 29 times in Germany. You see something similar on the household side, which I don't know if Gabrielle as well, and we just use Germany as something. It's this is the HDSP to interest paid chart, Gabrielle, if you don't mind, you'll see a similar evolution, basically, where you see that the interest coverage ratio has gone from kind of like in the prior cycle 10 times up to about 25 times discretionary spending or available discretionary spending. And so therefore we come into a period where consumers and corporates were basically completely insensitive or relatively insensitive to the next rate move because interest is such a low component of their EBITDA or their disposable income.
And what was the mechanism that achieved that? Is that because fiscal policy was so accommodative that you have a flow of funds type shift, allowing companies to pay down huge amounts of debt? It's not like rates have collapsed.
No, I suppose really, if you like, we think it's quite unusual. So, for example, the household interest bill in Spain in 2008, when you think about it, was roughly around 54 billion. In 2022, this is the amount of interest paid by households alone. By 2022, that had fallen to 15. So the rate charged on the debt basically had moved from about 6.4% or about 6% back in 2007, 2008 to basically around 1.5% in Q1 2022. And over that time, incomes grew. Number of people employed grew, incomes grew, discretionary spending power grew. And so therefore we have had, this rise in the interest coverage ratio. So, I mean, if the interest bill is basically, 3% of your EBITDA, you're going to be relatively insensitive. Sure. Even if rates double, then it becomes relatively insensitive. So when you put all those things together, and you kind of say, look, why are rates still? We've been very, very, bearish on rates. We think rates have had a lot of work to do on the upside for the last 6 to 9 months, which is one of the reasons why we've been exceptionally bullish on European banks. And if you put those reasons together, the fall in essential item inflation, growing wages, high levels of discretionary spending power that still exists in the economy, high levels of interest coverage, or insensitive to interest rates, basically because of high coverage ratios in the household and the corporate sector, then you begin to form a picture of why rates have had no effect, and why people still expect 1% real GDP growth in the US, or we're only now more recently talking about recessionary type characteristics in Germany. And so therefore it's quite difficult. And I think the central banks actually have more work to do on the upside, not on the downside. And rates actually are still biased on the upward because, I think everybody is trying to call the peak in rates. But as long as this data persists, and we see this monthly, it becomes very, very difficult for central banks to take the foot off the pedal.
Yeah, so recent rate moves must have been quite gratifying for you because the rate markets have been absolutely whacked in the last month or so.
Yeah, look, we still think it's actually still biased upwards. I still think it's biased upwards, and you still have to see. Now, obviously, Harry, it's going to work. Don't get me wrong. This is going to work at some point. I think, we'll come on to it in a second. I mean, when we expect what's going to happen to corporate coverage ratios over the next 3 to 4 years, and what's going to happen to household coverage ratios, then we're obviously going to have some level of effect. But it's going to take some time, and we are still in this sweet spot for, particularly for European banks, whereby the rate curve is still biased upward, and we're not getting anything on the cost of risk. But I suppose that's really, really important, though, for us, just as a firm, to try to understand why. Because we don't want to be reactionary, try to think 6, 9, 12, 18 months forward and just say, look, actually, where do we think rates peak? And certainly we think they're still higher than where we are today. But the factors that influence that decision are still telling us that we're going higher.
So where do you think rates peak?
That's an exceptionally difficult question. We know it's going to work at some point. And I suppose one of the things I should say, actually, Harry, which is actually an important consideration as well, is that we're assuming that it works because central banks actually won't go down without a fight. And the reason why I mentioned that is because I know we might come onto it in a while, is because obviously politics is becoming an increasingly important consideration when we think about where rates can peak, because Once the rate curve begins to have an effect and we do start to get recessionary type characteristics, once these discretionary spending parametrics start to slow down, once coverage ratios start to come down, then will politics become more important? We hope not. And we do think that the central banks won't go down without a fight. But, certainly we could still see, in Europe, is it impossible to see, another 100, 200 basis points, maybe even more of rates relative to where we are today? And I think the market is basically expecting rates to fall into 2024. We think that's highly improbable, highly improbable, once the central banks begin to understand the narrative of the fact that there's this excess demand still exists, and we still haven't had an adjustment in coverage ratios. Let's not forget, Harry, I mean, even for interest to flow through the economy does take a long time, because, for example, you have a fixed rate mortgage in Europe and Germany for 20 years. You only reset once every 20 years. You're still paying, you're completely insensitive to the rate curve. So, I mean, this does take a while to flow through. One of the countries actually where we believe rates actually could be significantly, and have been, quite bearish, is actually the UK.
Right.
We think the UK is actually a bit of a unique situation. We haven't been long UK banks. UK banks, we feel, are a bit of a value trap, because we feel the UK actually has a lot more work to do than Europe and the US on the upside.
I see. Unique in a bad way, not in a good way.
I don't want to call it. Let's not call it a bad way. Let's just call it let's call it, they have, if they want to sort it out, they have to go higher. And I suppose when I say sort it out, what do I mean by that? I mean, I suppose the UK, in a post-Brexit world, without getting into the politics of that, feels, I suppose we've had 4 or 5 crises over the last kind of like 30, 40 years in the UK. We've analyzed these in detail, and in each crisis, to kind of solve the issue basically and get the UK back into a trajectory where we have real GDP per capita on a growth basis, it has had to adjust its rates to such an extent that it trades at about a 200 to 300 basis points premium to the US in real terms. If we were to do that today, that tells us the UK rates probably should be somewhere in the order. I mean, I think last year back last summer, we said, you don't laugh, but when the Bank of England was calling peak rates at 4, I think we were saying rates probably have to go to 7 or 8 at that time. And we couldn't understand the UK decision. Now, if we put in a 2% premium to the US, we're probably looking at somewhere between 10 and 11. I mean, the big issue for the UK is basically the UK has been going through an era of overspending on the consumer side for a significant period of time. And even if you look at the gross savings ratio in the UK, Harry, today, the gross savings ratio in the UK is probably double what it was pre-COVID. So therefore, the excess demand that exists in the UK is actually pretty phenomenal. Now, obviously, that seems to contradict the traditional narrative that the UK is in terrible shape, but actually, the UK economy is actually doing pretty okay, and that's why we're getting revisions up now. So that's, I suppose, when we think about the rate curve, that's how we think about it, and we look at this monthly data, and it keeps telling us that actually rates have to keep going up. And I think this is what it helps us to do, Harry. It helps us to understand the narrative around it, which we hear every day about peak rates and when is it going to have an effect. But when you put all those factors together, you can see very clearly, actually, it's pretty sensible why rates would be ineffective if you have this excess demand still existing in terms of discretionary spending, and you have coverage ratios that have been exceptionally high coming into this cycle.
So does that, for me, politically, the place where it's politically most sensitive to raise interest rates in the G10 is probably the UK, because of floating index basis for real estate, and because everybody who's anybody is long up the yin yangs of UK property in the UK. So that, if I were to be biased, I'd take the under on where UK rates end up, not relative to your estimate, not because you're wrong, but because if anywhere is going to have political pressure to do more through fiscal and less through rates, it's going to be the UK.
Yeah, I suppose, look, you could be right. I mean, ultimately, how does it end up? I mean, it ends up either in the currency market or in the rate market. Yeah.
Right.
So, I mean, if we do undershoot on rates, then obviously we probably end up in the currency markets in terms of a weaker GBP. I mean, for us, you still haven't had that adjustment in the UK. I mean, I think if Gabrielle wouldn't mind put up, there's a chart where we make an estimate basically of salary to monthly mortgage repayment in the UK of where we are today over the last kind of like 30 years, 25, 30 years. And, I mean, it's a little bit dated now, but that number today is probably closer to 24, 25% for a new buyer. So therefore that a new buyer is basically roughly spending 25% of their income today if they were to go into buy a home in the UK. This is higher than the GFC, but we haven't had that adjustment in house prices yet in the UK. Are we going to have that adjustment in house prices in the UK? We would think so. We would hope so. And we actually think it would be an important thing that we do get that adjustment in the UK. If we don't get adjustment in the UK, then we're, entering into a different conversation. And we have this phrase internally, which is not meant to be funny. It's actually quite serious. Is that hopefully we don't all end up going Turkey.
You mean Erdogan policy, the Erdogan policy mix?
Exactly, right. where we just keep rates too low. And I mean, and like the worrying thing, I suppose, really, when you see it, and this is why I suppose we're quite, we still think that obviously politics is going to interrupt. But one of the key tenets of this is that we don't think central banks go down without a fight. And so, even though we have had intervention in the UK more recently, with Jeremy Hunt saying basically that banks need to pass on more deposit rates to their customers. They should limit repossessions of homes for 12 months. I mean, it's quite unhelpful, I would think, to the implementation of monetary policy, and it would give greater credence to your argument basically that we could end up lower than what we should end up. But obviously, if we end up lower than what we should end up, that's not a positive outcome for
sterling,
for
sure.
The less well-paid elements of the workforce will obviously suffer significantly, and therefore we have higher inflation for longer, because you still will not eliminate that excess demand. And so, look, I mean, there's always a choice to make, but I suppose one of the big things here is, look, central banks will not go down without a fight. And if central banks do not go down without a fight, then we're going higher, Harry. We're going much, much higher than what people think, because again, I keep reiterating, discretionary spending power in the UK, in Europe, in emerging markets, in the US is much, much higher than what the market appreciates, with essential item inflation slowing, wage growth strong, and we enter into this with coverage ratios that are too high. On terms of interest coverage ratios. So look, if we do get that adjustment in the UK, like, I mean, we run the scenarios for some of the, there's some listed REIT companies in the UK, Harry. If we were to, housing office transactions in the UK are declining quite precipitously because just the bid offer spread is widening quite significantly. We see something similar happen in the residential market, to be honest. But if we were to kind of put through kind of like, where relative to, 18 months ago and today, what is the bid offer? What is the bid ask spread differential that we should have in a commercial property in the UK? And we think commercial property prices, which are down probably 10 to 15, or probably should be down on today's rates, probably should be down close to 50.
Which is a lot closer to the marks you see using closed-end investment trust valuations.
Yeah, exactly. But that's today's rates, Harry.
Right. Oh dear.
Yeah. Oh dear. Exactly. So you put that into the residential market. Now, obviously, if we do get that happen, I mean, I think, obviously it's going to be pretty painful from a financial markets perspective, but it's actually very positive for the UK over the medium to long term. And that's what generally happened. It happened in the 70s, it happened in the 80s, it happened in the 90s in the UK, where it actually took those tough policy decisions. And again, we're back into this question today of whether we do have, the gumption to actually do this time around. We think that the central banks won't go down without a fight. That's the key thing. I mean, what happens after that fight is a different question. Maybe we'll come back to that another time. But we won't go down without a fight.
Well, a lot of it is about political burden sharing.
Sure.
Whether it should be property owners who take the whack, whether it should be businesses, whether it should be renters. Right now, obviously, I'm British. I've got a lot of contacts in London. My brother and sister that still live in London, and what they tell me is that rents are absolutely screaming. It's a distress situation for renters. And it's going to cause political problems, because what you've got looks a little bit like an intergenerational transfer, where younger, more indebted people are paying up through the nose, and older, property-rich people are benefiting. This is going to cause longer-term political stress there. Same as in the US, frankly. In the US, you've got monetary policy being pushed by a Fed higher. And as you pointed out, not everybody pays those rates. Quite a few of us, 30%, I think, roughly, of the US mortgage market is 30-year fixed. They haven't noticed.
They haven't noticed, yeah. So therefore, we are relatively insensitive. And I suppose that's the big, with discretionary spending, with fiscal policy, et cetera, et cetera. But then when we think about that, Harry, then when we come onto it, and we look at, there are going to be implications across this. I mean, we mentioned the UK as being a little bit more vulnerable. The other country that looks quite vulnerable in terms of what we think about when we think about the banks and the investments that we would make, or, payment companies or the REITs, we would think, France looks vulnerable. Why? Because French household debt over the last decade, if Gabrielle wouldn't mind putting up the percentage change in household debt for France across Europe, and also the corporate debt numbers, you'll see that French debt is up kind of like 80-90% over the last decade. In the following chart, you'd see corporate debt basically has gone from roughly 100% of GDP 20 years ago to about 160% of GDP today. And so, even though I might have shown you Germany coming in at 28 times coverage in terms of its corporate debt ratios, France comes in at 6. So therefore, as we move forward, the French numbers, for example, are going to have an effect. So if you look there, France comes in during the last crisis, it was 3 times. We're now at 6. Germany's at 29. Profitability is roughly half in France, corporate profitability relative to what it is in Germany, and on a total basis. Debt is double what it is in Germany. And so therefore you put those two things together and you go from 6. Now, if rates go plus 500 basis points from when they started to rise, the average interest coverage ratio is going to fall to 1.6. That's a pretty big number. That's a pretty big decline. I mean, that's lower than any period over the last 25 years. So is that going to cause some stress in the system? I suspect it is, because let's not forget, as we've transgressed through this period of rising rates, we've had issues. We've obviously had issues in the US financial system, the banking system. We've had issues with Credit Suisse. We've had issues in the UK. Is there going to be more issues? Yes, there are going to be more issues as we adjust. So that's the other thing we have to be careful on. But I suppose coming back to the idea then, is that actually one of the other countries actually that we feel is going to have a problem is Brazil, actually, if rates persist here as well. But we can come back to that to another time.
No, let's when you can, let's touch on the Brazil. It fascinates me.
So the narrative in Brazil basically is quite straightforward. So again, Brazil made the choice. So we had let's call it protests in the street in Brazil in 2014 ahead of the election. And between 2014 and 2021, total economy debt in Brazil grew by roughly 50 to 60 percentage points of GDP. Interest rates at the time peaked in 2015. And between 2015 and 2021, rates fell precipitously, basically from about 15 all the way down to 1 to 2 in Brazil. I mean, it was an amazing time as debt grew. So therefore, you had a situation where interest coverage ratios again, rose really, really sharply. But what was really, really important about Brazil at that time is that if you look at, real GDP per capita in Brazil between 2000, last crisis, 2000 and 2014, that it rose every single year. But since they entered into this policy of aggressive debt creation, then we have had no real GDP per capita growth in Brazil. In fact, it's actually declined. So therefore, you had this excessive debt creation with no productivity growth. And that is really a recipe. That is a recipe for a disaster, basically, once it comes. If Gabrielle can put up the chart, we have just a brief. And how does it actually flow through? It's just a debt analysis by sector in Brazil. So you'd see the total economy debt is roughly around 172% of GDP today. But front book rates are well above the back book rates across all the various segments. And the debt, one of the things about Brazil actually that makes it quite interesting is that the duration of the debt is quite short. So unlike the UK, where government debt has a duration of, let's say, 12 to 15 years, or in France, it's 7 years, most of Europe, about 7 to 8 years, in Brazil, it's actually 4. Yeah.
Oh, that's lengthened since I last checked. It was 3 last time I checked.
Yeah, but like a short duration. This is short duration at 171% of GDP in terms of total economy. Government at 84. And so therefore, when the front book, as we call it, the front book rate, i.e. what they're funding at today, flows into the back book rate, which will happen over time because the governments will have to fund at a higher rate, then you kind of get over the next 3 to 4 years, you get basically, you're kind of, the extra funding required as a share of GDP is roughly 2.5%, in 1 year. And over 4 years, you need to knock basically 9.6% off your GDP in terms of the higher interest bill. And that's actually quite a big number. And actually, I didn't put it here today, Harry. I didn't show the chart. But if you were to look at the household debt service ratios in Brazil, I mean, they're going through the roof. Now, we haven't had a cycle yet, but again, we're having a similar narrative in Brazil as we are in other countries, in terms of now governments are becoming increasingly involved in trying to preserve household cash flow. So they're talking about cap on credit card rates. They're talking about
credit card rates are punitive in Brazil.
Yes.
It's such an amazing way of making money.
Yes.
If you're a Brazilian credit card company is my favorite. If I come back, I come back as a Brazilian credit card company.
Yeah, they have been pretty terrible now in terms of investments over the last little period. But we think this is the reason actually that we are going to have, and are we going to have an NPL cycle in Brazil, a significant NPL cycle in Brazil, non-performing loan cycle? The risk is, yes, we are, but obviously if the government intervenes and caps credit card rates or caps other kind of rates or decides to give more money to households, then we probably won't be having a credit card cycle that we would expect that we should have. But again, how does this flow through? Not everybody can be a winner.
Yes, it's the burden sharing question again rears its head.
Yes,
and the government can intervene, putting a finger on the scale to decide who it is that pays that bill.
Yeah, so therefore, I mean, some of the interesting events. What should you do with Brazilian banks in USD? Are we going to have a credit card cycle or a credit cycle or not? Or if we don't have a credit cycle, are we going to have an issue in relation to the USD BRL rate? But this flows through. I suppose this narrative is something similar that we see in the UK. Again, we think rates should be biased upward, not downward, even though they're talking about cutting rates in the next cycle. But like when we come up with, I know we've skirted around a lot about rates over the last little while, Harry, but when we come on to it, then we kind of say, okay, how do we make money?
Yeah.
How do we make money here?
Always.
So it's obviously not easy. But what we try to do is try to understand. What we try to do is try to understand, like, what is the environment in which these companies operate? Yeah, what are the factors that influence the outcomes? And so therefore, then when we speak with the banks or the payment companies or the REITs or the diversified financials, the asset management firms in Europe, we have some understanding of how we think. If we can mirror what they tell us versus what we see from our data, then we can kind of have an interesting conversation about potential investments. And look, we've been exceptionally bullish on European banks for the last 12 months. I mean, the stocks have done well, but they haven't actually re-rated from an earnings perspective. I mean, they've really gone up because the earnings have gone up. And really, interest rates in Europe, as I said, have been low. So if we think about the factors that are going to influence the banks, and you're going to say, well, obviously interest rates going up is a positive. I mean, as we mentioned, the amount of interest paid in Spain was 55 billion in 2008. It's 15 billion today. I mean, banks are in the process. What do? Banks basically earn money on a customer spread where they charge you for your loan. If the loan rate is higher, they have a greater opportunity to make more money on that loan.
Sure.
So obviously that's one thing. I mean, we look at German front book corporate rates are up 350 basis points. So if you want a loan in Germany today, you're paying 350 basis points more. So that's more positive for the banks, assuming they can manage their risk. But a couple of other things are really, really important actually as well for the European bank narrative is that it's not only a rate call here. I mean, that's the easy thing to do. The thing that's really, really important, I feel, is actually that people are misunderstanding the fact that banks have been disintermediated for a decade. And what do I mean by that? I mean, look, I mean, we use Spain quite often in our analysis here in terms of we look at Spain. I mean, corporate debt in Spain is roughly flat over the last 12 to 14 years. Since 2008, it peaked at about 1.3 trillion. It's 1.3 trillion today. But over that period, the bank's share of that credit has gone from roughly 65 to 70% share to about 30 to 40% share. So the banks have actually lost an enormous amount of market share to the bond market, the private credit markets, and to other players over that period. And so that's really, really important when we think about the other element that influences the bank, basically, which is, are they going to have an issue as corporate coverage ratios converge to normality over the next 3 to 4 years? And as we do get this push on rates and we do get the coverage ratios converge, how bad will it be for the corporate credit cycle? And on the basis that the banks have lost market share for a decade, we just wonder who has these loans now, because it's not only the banks. It's actually other players who may not have been as good underwriters as the banks have been over the last couple of decades. The other thing that's really important, Harry, as well. Sorry, go ahead.
No, I was just thinking about, for some reason, private equity popped into my head, but you already said you didn't like private equity.
Well, I think when we think about private equity, is actually, let's just focus on private credit. I mean, watching some of the proponents for private credit. I mean, obviously the proponent of the proposition is that this has never been a better time to write a loan, because now I can get I can now get a loan for 6, 7, 8% basically on my what we call the front book, i.e. on a new loan. The problem is, what about your back book? So what about the firms who are refinancing? So we actually use the narrative. If we can split the German data basically into what the banks funded at and what the non-banks funded at. So the banks funded at the trough, at peak coverage, the banks basically gave loans of roughly around 2% to a corporate, 28 times interest coverage. The non-bank sector, private credit, bond market, funded at 1, at 28 times interest coverage. If we're right and rates have, even if rates, that interest coverage ratio today or somewhere in 2 years' time, is when these guys come to refinance, is going to be somewhere between 4 and 6 times. So will they be able to refinance at 1%? Highly unlikely. Highly unlikely. Let's call it.
Yeah, we're hearing some interesting anecdotes out of Germany, for example, on real estate lending. And there is a fair amount of, I'd call it pseudo distress, where people need to find bridge loans, can't find it on normal terms, so they go to specialist lenders who offer them rates of 15 to 20%, and they balk at those, shop around, and come back. And it's the coming back that I find fascinating. I can understand rejecting 15. I can't understand paying it.
No, but again, I suppose the thing is, look, obviously we have the stress in the commercial real estate market in Europe. That's obviously pretty
absolutely
evident. That's evident. But look, I suppose that it reminds me of what happened in 2007 in terms of when we did have the Bear Stearns hedge fund issue in March 2007.
Sure.
It really was about 12 to 18 months before the full effects flew through.
Great point. Such a good point. Absolutely.
And so we always focus again on the most vulnerable, but this is going to affect everybody. This is just not unique to the commercial real estate sector. This will be all corporates will have much higher refinancings in terms of what they have to pay. And the issue from the bank's perspective, obviously that's an opportunity for the banks to some extent in terms of regaining market share where they've lost market share for a decade. But the second thing, actually, if Gabrielle wouldn't mind putting up, there's a chart where we the the funding spread between the domestic banks and other. And I think this is really, really interesting in terms of the bullish case for the banks, because, we obviously the rates are important, but the banks have actually also lost their pricing power over the last decade. And what does this chart show? This chart basically shows is, so banks, if you want to go to a bank, Harry, you generally have stability in your funding. I mean, they're there for you, generally there for you. They're not, they won't default on you unless it's absolutely, generally it's there's a process you go through. The bond market is obviously more volatile in terms of it's a willingness to fund at a specific rate. The banks basically have lost their pricing power over the last decade. And so if you think back pre-GFC, banks used premium for bank funding was running at around, let's call it 200 to 250 basis points. The corporates were willing to pay. So not only have banks lost market share, but also their pricing power was limited over a decade. And so are we entering an environment today? We think we are, that people will now, where stability of funding will become increasingly important in terms of its ability to access funding. And we think, yes, the banks are going to be able to have that funding, and will corporates be willing to access the banks back to the banks? And we think people will. So therefore, even though loan growth is obviously going to slow, balance sheets might contract, but the pricing power of the banks, if you think about an industry, what do you want in an industry? You want to basically an industry involved in an industry with pricing power. Pricing power is much more important than volume to some extent.
Hell yeah.
So if the banks can regain pricing power, then this becomes a very, 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 very strong story. And the other thing, clearly, which we should, if Gabrielle also wouldn't mind, just in terms of European banks, is the loans to deposits ratio of the domestic private sector. And this is actually really, really important as well, because the banks do have significant amounts of excess liquidity. So this is Italy, for example. This is the loans to deposits ratio in Italy, which has gone from, I mentioned, Italian corporate credit basically is, again, flat for over a decade. Deposits have grown quite strongly, which means, again, households have a lot of excess net worth creation. But, banks are very, very liquid now. And, this is, apart from the French banks, this area is, this is, a theme across all of Europe, where the loans to deposits ratios basically are very, very low.
Can I interrupt you briefly?
Sure.
Just hold that thought. Why is France an outlier? What happened? It looks like they expanded credit provisions significantly somehow.
Well, I suppose, French corporate credit, as I mentioned earlier, has doubled. And French corporate credit has gone from 100% of GDP back in pre-GFC to 160 today. Corporate credit has doubled in a decade. Household credit has doubled in a decade, and corporate credit has doubled in a decade. And that isn't obvious. German credit is up, but not significantly. So therefore, the French have basically run a more levered model, and you can even see that somewhat a little bit in the differential. I mean, we are, obviously, I'm sure you've had people on speaking quite significantly about the differential between between German and Italian credit spreads, which is a key parameter for stress in the Eurozone. I mean, one of our worries to some extent is that we're now seeing a widening of the credit spread between France and Germany. And I mean, if you think about a country that's taken on significant amount of debt, just as rates have accelerated higher, then, probably, I don't want to say it yet, but, is France potentially the weaker element of the Eurozone? Potentially. Is what's happening in France, these social issues that are happening in France today, maybe symptomatic of what, a deeper issue that are related somewhat to the excessive debt creation over the last decade? Then, potentially, I mean, all these things kind of intertwine to some extent, but, like, I suppose France, but all the other regions, basically, when we think about the banks in Europe, they're liquid. They might have pricing power back. They mightn't have all the credit losses this cycle because they've lost market share for a decade. They obviously will benefit from a widening customer spread. And so therefore you're entering into an environment where, they're much higher capital ratios, and you're kind of saying, well, I mean, I didn't show you ratings in some of these stocks, but these stocks are trading at, distressed valuations on a price to earnings or price to pre-provision basis. 4 times earnings with 10 to 12% dividend yields, with, earnings potentially biased upwards. It seems
So
risk reward seems good.
which regions in Europe have the cheapest banks?
We've tried to focus on banks basically that have a high level of sensitivity to net interest income, where there has been limited credit creation over the last decade.
Sure.
That's really, really important, because if you haven't created much credit, then obviously you're going to be less sensitive to a rising rate cycle.
Right.
So the focus for us has actually been on the banks that were in the crisis during the last GFC, which is the Italian banks, the Spanish banks, the Irish banks, and maybe one or two select banks in the Benelux and Germany. But in general, we've tended to avoid banks in France, in the UK, Eastern Europe to some extent, because again, policy is a little bit more difficult there, but just focus on banks where there are, that have these characteristics: low loans to deposits ratios, no credit growth. So therefore we just get the full benefit of the rate curve. And, ideally banks that do buybacks. So
Right.
the other thing that's interesting, Harry, is that, even if rates do, we don't expect rates to fall, but even if they do, banks still do okay in that cycle for a period. So,
Sure.
at these values, I mean, we're pricing in a very exceptionally bearish scenario. And the way we think about that, in terms of, because the banks have lost market share for a decade, you have these high coverage ratios, so you don't get cost of risk or poor provisions for a period. But the offset of that actually is, just in terms of the private equity asset management sectors are going to have a lot of challenges in the coming period. And why is that? There's a couple of reasons. One is there's a mix effect flowing through in terms of, as bond yields keep pushing higher. I mean, ultimately, bond funds are going to become more attractive, because they'll be paying 5 to 6 versus an equity that's volatile. If bonds are paying 5 to 6, your equity could become more difficult. So therefore, you have a mix effect whereby the margins that these firms earn on their equity product is a significant premium to the margin they earn, which is kind of like 5 to 10 basis points basically on a bond product, versus somewhere up to 60 to 70 on an equity product. So you have a negative mix effect. You have household cash flow normalizing eventually once this rate cycle progresses. So therefore, the flow into asset management will be weak. And then you have, I suppose, many of these firms would have been overly aggressive in their cost basis over the last kind of like several years. So you get potentially an environment where you have revenue falling and, you have an inflexible cost base. I mean, asset management firms in general are not great at rationalization. And so, it becomes a very, very interesting period. I mean, and one of the things we find about, even you can see it, if Gabrielle wouldn't mind, just putting up the couple of charts that we have on private equity towards the back end we have basically where, obviously private equity, I mean, even in the UK, they're talking about allocations to private equity, but, private equity allocations basically were gradually moving upward, from 15 to 21. Then we got this acceleration during COVID where, everybody had to get into private equity. But that was just precisely at the time when rate curves were low. But all these things refinance in 4 years' time from 1% rates at 4 to 5% rates, or 7, 8, or 10% rates. We're not sure. So will private equity give you the type of return that one expects over the next several years? And we suspect not. And then the following charts will show you what's happening, something similar to what's happening we mentioned earlier about the commercial real estate transactions in the UK. If you look at private equity deal counts, if you look at the European deal counts, these things are falling precipitously. I mean, we're back at 2008 levels in terms of
money
by value. But
yeah.
these deals were all done. A lot of these deals were done at 28 times interest coverage at 1% rates back in Q1
Sure.
2022 and prior. Now we have to refinance at 10, and I suppose, but then we know this is coming, Harry. Yeah, I suppose that's from our perspective. We know this is coming, and you asked the question, when does it happen? I mean, obviously, we all want to know, when does this actually happen? That's exceptionally difficult. We just keep focusing on the data. If we keep focusing on the data, hopefully the data, and we keep trying to look forward, will tell us when we're beginning to see the stress. We obviously talk to the companies, they're not seeing it yet. The data is telling us it's not yet. And if those conditions still exist, the banks are telling us not yet, our data is telling us not yet, the discretionary spending is going up, the coverage ratio is still too high, we still have higher rates, we still have work to do on the upside. And in that environment,
not yet. Right.
Not yet. We still got it. So, that's why we've been exceptionally bullish on European banks for a period. We're still bullish on European banks, ideally periphery. We feel that the asset management sector is going to be very, very challenged.
We got a couple of quite interesting questions from the audience. So Joseph asks, given demographics have not improved in the EU or the US, and AI will take some time to improve productivity, do you see financial repression returning after the excess savings burn off and base effects on wages stabilize? Or do you see an enduring upward wage pressure for years?
Well, I suppose the financial repression question is probably one of the most important questions one can ask. I mean, in terms of ultimately where do we end up? Because obviously, if we do get financial repression in terms of the government's choosing, I mean, there was a period after World War II in France whereby they directed where the banks lent. So they determined policy, basically determined monetary policy between 1945, I think it did, about 1968 into the early 70s, whereby the government dictated policy. And that is what financial repression is. So will you be dictated? Will we be dictated to buy government bonds ultimately to preserve the nominal, the perception of will we be to the perception that everything is okay? And again, I suppose my answer to that is I come back to the fact that central banks won't go down without a fight. So I think financial repression comes after we have had that fight. And the only question then that's important is at what level of rates do we have that fight? We think it's higher, but it's coming. And once we get, we'll know when the fight starts. Let me put it like that. Then obviously has different implications for gold and various other things, because then we're in a different environment of financial repression. We don't see it yet.
I see some signs that the fight has already started, but it's certainly not. It's not a hot war. And I say that because the Fed's there hiking rates, for example, but the US fiscal deficit is 8%. So if they had any control over the fiscal situation, they wouldn't necessarily have to raise rates as much. Clearly, they don't. They're not the US government and the Fed are pulling in different directions. Paul also has a question. It's a good one, actually. What is the most important difference between European and US banks that will give you European bank outperformance? Why do you get European bank outperformance?
I suppose there's a couple of questions. One is Europe had a crisis in between 2009 and 2012-13, whereby in particular exposure to certain sectors fell. So commercial real estate exposure, for example, in the US regionals is roughly 30 to 35% of total loans. In Europe, 5 to 8, right. Significantly lower. Second thing is the European banks, that's on the cost of, let's call that a cost of risk issue. Secondly is the credit growth in Europe has been an awful lot lower, similarly related to the cost of risk issue. The other issue that's really, really important is around deposit betas, what we call deposit betas in Europe versus the US. So like the US saver seems to be a lot more sensitive to the rate curve in terms of their willingness to move. So obviously we have money market.
Yes, I am. I'm already in T-bills. It's a ridiculous thing to receive the deposit rates they offer you and have the risk on deposits. So
and so like that is less of an issue in Europe. Now, that's not to say it isn't an issue in Europe. It is an issue in Europe. For example, more recently we're seeing, I think there's been roughly year to date, roughly about 50 to 60 billion flow into BTPs in Italy, for example, which are yielding 4 to 5, versus the depositors and the Unicredit and Intesa paying basically close to limited. Let's just call it limited. But because we don't have the same level of, I suppose, homogeneity, this easy transferability from deposits into T-bills, and I suppose maybe it's because we're less financially astute in Europe versus the US, with not as deep kind of a money market funds, then you don't get the same level of deposit pressure as you do in the US. And so therefore deposit betas in the US have actually been really, really high. Deposit betas in Europe have actually been really, really low. So, like we can look at, somewhere like Ireland, Slovenia, Portugal, where, even though the ECB has moved by close to 400 basis points already, they have passed through probably, 20, 30 basis points of that move. Even though, so you get that issue. The other big thing about the European banks basically is that, over the last decade, they've been subject to significant regulation such that capital ratios have improved significantly. And the US banks, even though they had good stress tests, the European banks are now entering a period where, on higher earnings, that they are now doing significant buybacks. They're buying back their stocks, their stock basically at 4 times earnings. So I can buy some banks in Europe with 10 to 12 yields. I'm happy in terms of my earnings outlook for the next several years, but they're buying back stock at 4 times. It looks like
it's a strong tailwind.
It's a strong tailwind basically. So if you have more buyers and sellers.
So we're running really short of time, but I really wanted to touch on this point, which is, the environment, what you described with upward pressure on rates sounds like a dreadful environment for US regionals, because they haven't really been rescued by the Fed. They've just had this problem pushed back into the future. So it seems to me that US money centers have the advantage of being able to feast on the carcasses of US regionals, buying their assets up cheap when they get put to sleep. Am I wrong to look at it that way? Is that not?
Well, we don't cover the US. We obviously keep an eye on the US because it's obviously an important market. We don't cover the US specifically, but clearly, I think it's a bit like, we're going to get issues occurring as we push on that. We've been pushing on a string. Some point that string will bounce back.
Rates can go high enough to hurt somebody. We're just trying to figure out who.
We're just trying who it is. Yeah, exactly. And that's why I think we can't be complacent enough to suggest, and we're certainly not complacent enough to suggest that this isn't going to have an issue for Europe. I mean, it is clearly going to have an issue for Europe in terms of the cost of risk for European banks is going up. Is there going to be differences between the UK, France, and Ireland, for example? Yes, there will be. Would I prefer to belong, or certain regions and the banks in those regions? Yes, but we're going to have kickbacks, Harry, and the issue is that what's happened to date is that for everything that's happened, for example, whether it's the US regionals, with the issues in the US regionals that we had, whether it's Credit Suisse, whether it's the LDI issue in the UK, after each of those issues, everybody has rushed to call peak rates. Yes. But the issue, when we look at the data is still telling us it's not having an effect. So, and a lot of these issues are happening outside the financial system. So the Bank of England responded to the LDI issue, the US government responded to the regional issue, the Swiss government responded to the Credit Suisse issue, but that isn't allowing us to have that reset. And so therefore, we are still in this movement upward in rates in an environment where we feel European banks in particular look exceptionally strong.
Seamus, that was fantastic. Thank you so much. We are pretty much out of time, but if people wanted to keep on top of your thinking, what can they do apart from sign up for your service?
Yeah, well, sign up. We actually do some blog. There's a lot of blogs on our website. We do a lot of blogs on these issues on our website, carraighill.com. So, and that's probably the easiest way. I actually haven't done much media, Harry. Would you believe? I've been very.
I don't believe it. You were excellent.
I've been very secluded for the last kind of period. We don't tend to, we don't do much of this. But look, we're really happy to be invited onto your show. So hopefully we'll get another chance to speak in the future.
I hope so too. Do come back, and thank you so much. That was wonderful.
Yeah,
really appreciate the steer.
Thank you.
We hope you enjoyed the video. At Real Vision, we help you understand the complex world of finance, business, and the global economy with in-depth analysis from real experts. Join the revolution at realvision.com.